Hi, my name is Peter Maloff. I'm a partner at Davidson Company. And I volunteered for this section. I like this section. It lets me get out my inner accounting geek, right? Bury myself into the standards a little bit. And, it comes to, and I've introduced some of these to you before, and you've seen some of these before, so it's a bit of an update. But what do you do when you look through the standards and it's not clear, or it doesn't apply to your specific set of circumstances, or where else do you go? I guess you call your auditor. That's fine, But another place you could go is as these three sources right here, right? Now, some of you you've seen before, right? Now, these aren't, I asked for a teleprompter. Apparently it's not in the marketing budget, so I got notes. Okay, so I'm gonna have to look it down these every once in a while. Three sources, right? Viewpoints, you've seen these before, right? None of these are authoritative. But since there's no specific guidance, that's what they're designed to address. Just additional discussion on topics that have a specific set of circumstances, right? Now, everyone's heard of the CPA, PDAC viewpoints, and they've been around for a little while. So what I'm going to go through here is there's two new ones, and there's two that have been reissued. Here they are, be aware, right, if the issue comes up. A little about the IFRS discussion group in Canada. It's a website. You can go there. I love this website because I have it on my favorites list in my browser, because you just click on it and then there's a section where it's a really neat search function. You type in one word and anything that has that word in the title, it pops up. It's really easy to search, right? And this is a bunch of Canadian eggheads that get together and to talk about stuff that's coming up, right, or stuff that is not clear. And what they want to do is raise awareness of the issue. And if they can't decide, or if it's serious enough, they refer that issue through the accounting standards boards up to the international guys, right? And that's the last one, the International Interpretations Committee. And now what they do is they take an issue and offer their discussion on it. And if it's serious enough, they will issue an Ifrs, like a pronouncement, at super guidance. This website for the IFRS Interpretations Committee is not as user-friendly. I went through and searched through all the meetings and minutes, and I found some stuff that I thought might be applicable, might be kind of interesting, right? Not as user-friendly, though. Okay, on to the viewpoints. Two new ones, like I said, and two ones that were reissued. First one, reversal of impairment losses. Not necessarily, it's not a new topic because it's always been in the standard. But this is just to raise awareness of it. In the PDAC's view, it just points out the fact that if you have an impairment, you're actually required to go through, see if any of the indications have provided that there's a reversal of the impairment, right? And it even applies to E&E properties, as well as any other property. The challenge, of course, with an E&E property is that it's tough to come up with an estimate of a recoverable amount, because there's no prudent probable reserves. It's tough, So while there has been an impairment in the past, things have gotten a little better. For you to record the reversal, you got to come up with a recoverable amount. Here's one thing to watch out for, though. If you have a situation where in your year you've recorded an impairment in a prior year, now you've subsequently sold the property and you got some proceeds for it, right? Well, if you sell it after the year end, but you sold it because it's before you reissue the financial statements, you should probably record that reversal in your year end, because look, you sold it. You know how much you got for it. There's no question on the recoverable amount. So don't wait till Q1, record it in the year. Just a small thing there. Right. Next one, accounting for decommissioning liabilities assumed in a business combination. It's a bit of a mouthful, and this is a super technical, geeky issue, but here's the scenario, right? The company enters into a business combination within the scope of IFRS 3, and includes the business combination, all the assets and liabilities, includes an ARO, right? Well, all the assets and liabilities in that business combination got to be recorded at fair value in accordance with IFRS 13. So you go through that process, fair value. Great. Do the purchase price equation. Well, on the day two, after that, every period after that, different standards tell you how you record those assets, right? At cost. Well, at ARO, it's what is it, IAS 37. It's recorded at management's best estimate. Well, when you record it on the business combination, it's at fair value. Now you record it at management's best estimate, different amounts. Typically, the one recorded on the fair value is a bit of a higher amount, because theoretically, pay a contractor to go, and how much would it cost for you to clean that up? You get an estimate of the cost, boom, it goes in there. Now management's estimating the cost on day 2, and they say, well, we're not going to pay a contractor, we're going to do it ourselves. We're going to hire 3 guys to get shovels and, fill in the ditch and plant some grass and watch it grow, and that's going to cost us a lot less, right? Okay, well, on day 2, you've got to record a lower amount for the ARO obligation. Where do you put the difference? The issue is that there's been some diversity in practice, which is why the viewpoint's been issued. And the 2 places where it's been going, of course, is to the asset and to profit and loss. This viewpoint suggests to the asset. That's what the conclusion is here. Again, not guidance, but since there's been diversity in practice, they suggest to the asset. 2 new ones that have been issued, flow-through shares. Now, they don't offer any changes to what's been issued before, so that's all okay. It's just new stuff. So the flow-through shares is exactly the same as before as the viewpoint. You've probably seen it, but now it offers, it's a share that issues with an attached share purchase warrant. What do you do in that case? So it offers you a bit more of an explanation. What do you do there? The same one with capitalization of borrowing costs. It's reissued. It's the same as it was before. They added a section. What do you do when there's been an impairment of the qualifying asset? So how do you capitalize the interest costs there? I mean, as an aside, I've never seen interest costs capitalized, but you see the flow-through shares quite a bit. All right, on to the next group that I go to. Like I said, I really like this website. The most recent meeting was in December 9, 2014, most recent one that I saw anyway, that had any kind of meat to it. There's a few issues that I really liked. Acquisition of an entity holding a single asset. Pretty simple, entity A acquires 80% of entity B for cash, okay? Entity B has only one asset, and it doesn't represent a business. The asset could be whatever you want. Say it's a mineral property, that's fine. It doesn't constitute a business, so IFRS 3 doesn't apply. We've seen this before. Okay, how do you account for the 20% that you didn't acquire? Well, this is what they say, okay? So group supported this approach. They supported the view that entity A should have recognized the 20% not acquired at fair value. Okay, entity A acquires 80% for $80, right? And then the non-controlling interest, 20%, should be $20, and the asset that you acquire that's in that entity should be recorded at $100. That's what they're suggesting, right? So be aware of that when you acquire something that isn't a business, it's a single asset, and you don't acquire 100% of it. When you go to this website, you can not only do you read the minutes of the meetings, you can actually listen to their discussion. You can click on it's like a taped discussion. It's really interesting. Okay, another one, December 9th again, depreciation of spare parts, standby equipment, and service equipment. Lots of subject. I like this one. Kind of points out 2 things, right? It says basically, if the spare parts, standby equipment, and servicing equipment are expected to be used for more than one period, they'd be classified as property, plant, and equipment, not inventory. So if you're in production, right, that inventory might not be inventory, it might be property, plant, and equipment. Then when do you start depreciating it? Okay, here's what it says. There's two subcategories here. There's a critical spare. That's a type of spare part that can be used in the event of an emergency breakdown. So you got another ball mill or something like that, right? So if the ball mill breaks, you get another one right there because it takes too long to get it in, right? That should be amortized immediately as a capital, amortized immediately, right? Then there's a capital spare. It's expected to be used in the normal maintenance cycle, and that should be amortized when it's actually used, right? So if you have a truck and you get tires, well, they're going to wear out. You bought some new tires. You don't amortize those. Classified as property, plant, and equipment, you don't amortize those until you put them on the truck. Okay. In the end, it ends up being a timing difference, but that's what it says. Right. Capitalization of costs. I like this one. I've been through this before, and basically the subject here is what's meant by the phrase "to be capable of operating in a manner intended by management." Right, commercial production. So when do you stop capitalization? You commence depreciation. So the Canadian, now bear in mind, this is in December 9th, 2014. They had, the way they always analyze the issue, here's the 3 different views, what's done in practice. View A, management uses a predetermined operating level as the criteria. We all know the 3 levels, right? View B, you capitalize when the asset can create output that it was designed to do on a regular basis, even if it's not necessarily at the levels originally planned by management. So a bit of a lower threshold, right? And then view 3, policy choice. Okay, you just do, as long as you say what you do, then you do that, So what's the conclusion? Well, this is where there's a lot of diversity in practice, and the group expressed varying views and recommended referral to the International IFRS Interpretation Committee. So they take their discussion and move it up the ladder, right? Here we go to the international group. Ta-da, capitalization of costs. So they've been talking about it too. So they've been talking about it in their meetings in November 14. Now, bear in mind that the Canadian one was December 14, so it looks like the Canadian guys saw that the international guys were talking about it. Hey, wait a minute, Canada's got a lot of this stuff. Let's get our 2 bits in there. So they did, and they keep talking about it in January 15 and September 15th. Maybe more meetings, but there's at least 3 that I could tell. They refer to the topic as accounting for proceeds and costs of testing. Now, what's the conclusion? Well, so far, the International Committee did not reach a consensus and directed staff to provide them more additional guidance. If you have the issue, or if you think you might, it's worth it just to see what their concerns are. That's what I get out of it. But like I said, I'm a bit of a geek when it comes to this stuff. So the international ones, these are a little bit older. IAS 8, right? Accounting policies, changes in accounting estimates. This was issued minutes from a meeting in November 2013. I like it because it has good discussion points. If you come across an issue, hey, is this a change in estimate, or is it, is it change in accounting policy, right? And it could be from my angle that I'm looking at it, but they seem to favor that if you're kind of in doubt and it's a tie, go to the fact that it's a change in estimate rather than a change in accounting policy. Change in accounting policy is ugly. You got to do a lot of work with that. So it just offers you some points where it might be an estimate. Is it an estimate or not? Go through it, have a read. It give you some ammunition to go back to your accountants with. Okay. Wish I had a joke for that, but I don't. Accounting for a couple other points. Accounting for reverse acquisitions that do not constitute a business. Well, we've all seen this before. Everyone's going to go, yeah, I've seen this before. I've done it 100 times. Well, this is back from November of 2012. That's where the minutes of this meeting are from. So it is a little bit older. And it basically states everything we've been doing all along, right? The excess of the fair value of the shares over the fair value of the assets, it's not a business, right, should be recorded as an expense. It's a listing cost, right? So this is where it says that they recommend that you do that. Fair enough. We've been doing it already. This one I thought was interesting, IAS 21. Effects of changes in foreign exchange rates, revenue transactions denominated in foreign currency. Okay, so what exchange rate should be used if a customer made a non-refundable payment in advance? So, now bear with me here, it's not only revenue. So a customer made a non-refundable payment in advance. When do you record the foreign exchange amount? Well, the tentative decision, they say that should be recognized on the exchange rate when they got the money or when it's receivable. Okay, seems to make sense. The foreign currency risk is taken away when they got the money. That makes sense. But an interesting point here is, too, they go on to further say, and this should be applied to other areas as well. For example, where there's some other element of a prepayment, like you prepay for capital assets, right? So as soon as you prepay for the foreign exchange rate is taken away, you take that cost, you don't remeasure it, you put it into your capital assets when you get the asset. All right, guys, thanks for letting me take you a little bit through my travels of the different sources of IFRS discussion, and by all means, give us a call. We can go over these issues anytime. What I might come back to you with is, oh, have you seen this IFRS discussion group thing, right? So this is why I'm presenting it to you guys now. This is where I get it from. All right? Thanks.